Well, the Future Group, and we thought we were going to chat with Future Lifestyle today. The fact that they're set for a very trendy comeback. CLSA has also initiated a coverage on the stock price. They're upbeat in the brand factory business. So what's really brewing in the retail business? Let's try and understand that with Rakesh Bayani, the director at Future Group. Rakesh, hi, good morning. Good to speak with you. Rakesh, Future Lifestyle has grown at a very impressive 21% revenue CAGR over the last 4 years, much faster than others present in the space. Tell us a little about where lies the next big trigger for growth there, and what do you believe will give you an edge over peers in what looks like an extremely fiercely competitive sector?
So I think over the last couple of years or so, we've sort of redefined the two retail businesses that we have, which is Central and Brand Factory. The Central high definition format, which is what's kind of the stores that we are rolling out, have performed very well, and we got a lot of new stores that are due to open over the next 2 years. So Central is good. The like-for-like growths have been very strong there, and that trend seems to be continuing. I think bulk of it is due to the fact that our focus on the assortment that we sell and the way the customer service that we are able to provide at that store has worked very well. Similarly, at Brand Factory, we believe that this is one of the most promising concepts that we have in our group, and tremendous potential. We've ended with 60 stores, and we are looking at a journey which takes us to 300 plus stores over the next 5 years. And there's a lot of work which is happening in Brand Factory, both on the product side and in partnership with the brands to make it one of the most promising concepts. And finally, what is going to continue to drive growth is the power brand business, and one of the key power brands in that is Lee Cooper, where we just recently announced the partnership to do the footwear business. It was an existing business in India with another licensee, so we've now added that into our portfolio. That would take the last year numbers for Lee Cooper itself will cross 600 plus crores. And I think for us, our journey on that is that how do we in the next 4 to 5 years make that into a 1600 crore brand. So it will become one of the definitely the most promising denim lifestyle brand in the country. So quite a lot of exciting things happening at Future Lifestyle. The last 2 years have been very good, and the promise ahead looks even more stronger.
Today on the show, but good to hear that kind of confidence, Rakesh. Tell me, what's making the analysts so excited about Brand Factory? How has it performed as opposed to your Central and Brands business over the past 1 year, and what is it likely to do in the short term?
So when you look at Brand Factory, almost 50% of the stores are less than 2 years in business, and there are the number of openings which are scheduled to come on is significantly large. I think we got about 50 odd stores which will come up in the next 18 odd months, and what we're finding is the fact that the traction across both metros and non-metros is both the destination is very strong, and it's a combination of what we do internally as well as the brand partners, and many of the brand partners have started recognizing the power of Brand Factory and as a channel, and so there is so much more product which is coming into the Brand Factory. The entire deal as an offering that is there in Brand Factory, where not only you are able to sort of touch and feel the product really, and the offers are sort of very attractive. We find that the youth come back in large numbers to these stores. Last year we've had several occasions where we've had to sort of regulate the entry into the stores, and then finally we sort of haven't had an appointment booking system which came in. All of that sort of shows the fact that the assortment strategy that we have sort of built in Brand Factory is something what the consumers are liking a lot, and it's also a reflection about the fact that the brick and mortar store business is going to be here for the very long run. And and you mentioned that there is cutthroat competition. I think the market is expanding so much in India that as long as you are sort of building the right proposition for your customers, there is more than enough customers walking into our stores and are kind of happy really seeing the product and buying it.
Yes, Mr. Bayani, can we now say that the balance sheet is improving or on that path? What are the few value unlocking possibilities that you're seeing for Future Lifestyle?
So already the balance sheet is quite strong. Both the net working capital has only gone down. The debt to equity ratio has been progressively going down, and that's the direction of efficiency which will continue. At the same point of time, there is a portfolio of investee brands that we continue to have, and there are opportunities in some of them that we have demonstrated in the past in terms of the kind of exits that we have done, and there are few more which are getting ready, and I'm sure at an appropriate time there would be an exit opportunity there which would bring in more value to Future Lifestyle. So and the power brands, I think we sort of while our focus has been on the retail side of the business, the power brand is something which sort of was lacking. But I think the sheer focus that we have now done with even our all business, which is the India's only real plus size clothing business, where there's also a very large online play that we are trying to do. That's looking quite promising. Lee Cooper I have already talked, and at the same time then the brands like John Miller's Colors, both of them are very promising, already very widely distributed, and we believe that over a period of time not only can we make our distribution more stronger there, but also there is really a scope to sort of do category expansion.
Brand factory concept is more like a discounting, you're selling merchandise at a discounted price. So when you're selling merchandise at a discounted price, what will happen to your margins? Will they be wafer thin? Because you're trying to generate volumes, you're trying to generate turnover, and are you compromising on your margins?
So I think yes, you're right that the margin play is much lesser as compared to a departmental store. But at the same point in time also there are two things which are important to note, that the productivity is higher, and at the same point in time operating costs relatively are much lower. So what that does is the fact that the EBITDA model that you're able to still generate out of those stores is similar to the ones that you do at your departmental store play. So I think whenever you have low margin, that doesn't mean the fact that your EBITDA is going to be low. It also depends upon what expense levels and what productivity levels that you are able to generate. So both are quite focused there, and plus what we are also trying to do is to ensure the fact that we can turn the stocks much faster, which is typically does happen when you have a discounted product.
Okay. Are you looking at getting more discounted store costs, concept in other products as well, or you will right now be sticking only to fashion and some brands where the markdowns would be significant, and that business is going to be very unique and limited to Brand Factory?
I think Brand Factory as a concept is quite complete. While it leads by fashion, at the same point in time it is definitely focused also on footwear and all kinds of lifestyle accessories. So it's a multi-category business, and over the period of time we will keep developing those other categories to become larger. The store sizes are on an average about 25,000 square feet, so there is a lot of space in the stores to present all categories in complete range and width. That would make the destination as a more attractive destination.
Your expansion plans overseas. I'm reading up on how you're expanding in the eastern part of the country, of course, in a big way. But do you plan to take the brands that you hold overseas as well? And more importantly, what kind of capex plans do you have lined up?
So the current plan is very India focused. I think there's a lot more territories that we can take our stores to. We've in the last 1 year or so, we've opened 4 stores in the east of India, and all 4 have done quite well. And there are, we will continue to expand in both Mumbai, Delhi, and as well as in southern markets. So that's where the focus of expansion is. There's no intention to go take any of the brands currently to overseas as a business model. And in terms of capex, it's quite close to about 300 odd crores is what we typically would land up spending per year, approximately, for funding all the expansion that we have planned. And the company is generating adequate amount of cash to fund for itself.
Rakesh, just want to understand, since you do have all that capacity expansion lined up, what's the square feet addition that you're likely to make in the year in terms of stores?
So between all the concepts put together, typically on an average per year, it's about anything between 800,000 square feet to about a million odd square feet.
How do I measure the profitability? Because all concepts will have different margins, they would have different footfalls, the same store sales also again would vary depending on which store we are talking about and which season are we talking about. If Diwali is in October this year, it could be November next year, it could have impact on the way we look at same store sales. So should we purely look at the profit which you are generating per square feet as a measure of where the business is moving?
Well, one measure is profit per square foot, the other is about the EBITDA percentage on the total sales. The EBITDA percentage is something which is we currently at about 9 odd percent, and our long term objective would be to go move into a double digit like kind of a level, and with the sort of an expansion that is planned, the back end costs continue to get leveraged, and which sort of ensures the fact that ultimately the EBITDA, the net EBITDA at corporate level will keep expanding. So I think the scope is such large to expand your business, whereas your head office, etc., which is already sort of evolved, that those costs really don't go up as much as what the business expansion scope exists. And plus, because of the fact that you continue to drive a double-digit like-for-like growth, that generates the EBITDA. The EBITDA generation from that is even stronger.
Well, great insights. Thanks very much, Mr. Bayani, for taking us through your plans. We really appreciate the time you spent.